Hey gentlemen, Sunday session with you, short clip. So what's going to happen 17 in terms of the predictions? This is going to be a commodity year for me. Commodity cycles turn after equity cycles. In 2009/10 we got the equity bottoms and a big bull run. The commodity cycles churned a lot during 09/10, but they ceased going down from the 06, 07, 08 subprime crisis and crash. Subsequent, however, to them ceasing to go down, they didn't make a great deal of progress. They started to make some progress, and then at that point the oil markets, this was now 14, mid of 14, came down exceedingly hard, as you know, from deep into the hundreds, 115, 103, 104 levels, where it had been range trading in a very tight range, then spilt, and that lost a huge amount. So just as the commodity cycle was starting to get its catch up, most commodity based indexes, which are very, very heavily weighted oil, so the Morgan Stanley commodity index, the MSCI, popular one, heavily weighted oil, Goldman Sachs commodity index, heavily weighted oil, usually overweight. In fact, in terms of oil is a very significant commodity, but even still overweighted in those indices. So what is happening now? Well, we had the beginning of the year where we called the Trump boom up in copper, and we saw copper where everyone was expecting shorts, expecting things to go short, bang, boom up. Now I'm going to tweet, I have already retweeted the beginning of this weekend, very good chart that was showing the commodity index, beautiful red line, squeezed hunt volatility funnel method setup that has actually broken out really strongly, which will be reflecting all aspects of the commodity growing strength. Of course, with oil having improved slightly, what we have is the index getting some strength on the weighting of oil, but it's not just about oil. So metals, precious metals and industrial metals, the copper we've already spoken about, precious metals currently a little bit on hold, if truth be told. I think this is going to be a very big year for them. Also look out, outside of the brother and sister that is gold and silver, do not forget to keep an eye on your palladiums and platinums that are slightly less monetized in perception but have unique properties themselves. So those are hard commodity metals that are less leaned on by the financial market for preventing the perception of the weakness of the financial system, because gold and silver have that insurance value against failure, and them going up is usually a canary in the gold mine. Softs, they're going to be strong. In fact, basically my perception is this rise in commodities is a precursor to some inflationism. And following it, making a clip about Donald Trump and how, you know, he's kind of going to be the nail in the coffin for white male presidents for a while, because they're going to precipitate an epic correction on his watch. Watch that later. If that sounds a bit crazy and wacko, see my justifications before you respond to that. I think we're going to have a little bit of a strength in the commodities, and that's going to begin, although not initially immediately, but it's going to begin to start creating an inflationary environment. Remember in this story, which I've steered you towards, ref Donald Trump and protectionism, one of the key components of protectionism is you start to pay more for stuff. Because if you're not having your Apple iPhones made in China, in huge factories there where people are paid 1/10 of what an American expects to be paid, your costs go up. If you start to have things made locally, if you start to unravel, one of the downsides, if you start to unravel globalization, is that you lose the arbitrage value of lowest cost producer. You're forced to do everything. Each country has to have its own manufacturing. Now, we will not go to that extreme. I don't think it's going to be allowed to unwind, but it's going to be a step in that direction to highlight how stupid we all are for trying to push back against the global control structure moving forward. So I think it's going to be the beginning of inflation year. I think that's going to be a precarious period for the bond markets. So the US treasuries. Also, you have to eventually watch the Bund on the European, but it's going to take the longest to show up there because they've got a lot of slack. You're going to have to watch the gilts, which are the government-derived debt here in the UK. But the big one to watch will be the 10-year treasury. And I think we're going to start seeing a little bit of unraveling potentially on the interest rate side. Now, for those of you that are involved in property, this is important because this means interest rates, the outlook for interest rates. There wasn't that long ago, a year ago, everyone was saying, a third of the bonds just about now are being released near zero and NERP. Now we have a Trump protectionism, nationalist thinking, not globalist thinking. You have a commodity cycle that's been in a mega bear following the biggest financial crisis, wasn't allowed to recover when it wanted to recover in 14, when it was gaining some momentum because one of the hugest category of commodities, the energies, got spanked. So don't forget, it wasn't just any old oil, it was oil, heating oil, natural gas, everything that burnt, warmed, consumed in a combustion engine, all went down as a correlated basket. The entire energy complex got taken down in cost. So forget about just the oil significance in the commodity index. This was energy, full stop. So we had all of these things come smashing down, and that's forestalled the larger commodity index. Now Jim Rogers is the man who says, the farmers will be the next millionaires and all of that. Well, unfortunately, I believe the middlemen steal too much of the margin on that for the real producer to get the bulk of the profits. But it certainly could be getting better for them. And I think softs, I think coffees, I think the industrial metals, the valuable industrial metals. I've already mentioned palladium and platinum, so keep an eye on those because they're not typically watched. We all just fascinate on gold and silver. I think as much effort by the system will be placed as possible to try prevent gold and silver having too much of an inflationary run, but I think it will prove to be unsuccessful, but it might stall its progress initially and take some of the gloss and the shine and mean it isn't the lead. So watch those around it. We've already seen copper. So this is my take. The return of inflation, a big wobble on the bond markets. Are we at the end of the cycle? I suspect a crashing of the stock market will see once again run into bonds. So we're going to get a little fake out. Everybody will call the top of the bond rally, the bond market, the 30 since 1982 bond bull market to 2017. You're talking about 30 God knows years, 35-year cycle just on the upswing. And everyone will say that's it, it's the top, and Trump has brought it all down on us. We'll get a stock market sell-off and a massive deflation on the assets because people will start to get the real frighteners. Remember, American shares have borrowed like hell to buy equity. They have loaded up on debt, cheap debt, to buy their own shares back, keeping their shares high on consuming their own stuff with borrowed money. So they've retired common equity for debt. This interest rate cycle starts to look like it's turning. That debt bill gets a whole bunch bigger. That means earnings fall. That means all sorts of things happen. We're at 2000 level ratings, year 2000 ratings prior to the dot-com crash on just about every measure. The bond market is at extreme highs. The bond market will fool everyone though. Everyone will call the top and then it'll get bought again when the equity market crashes. And people go for the classic flight to safety. And I say safety, inverted commas. The real safety should be the gold and silver. And maybe there'll be a bit of more of a bleed to it. Maybe there'll be less enthusiasm this time for the bond market. But despite that, the bond market will get the bid. They will get a bid of sorts. So that's my take for asset classes. Prepare for an equity crash, a wobble on the bond market before, but then the bond market to stabilize as people flee from overrated equities into debt, and commodities to get more expensive in the run-up to the topping out of the equity market and the beginning of fear about inflation and rates increases. And I hope that's proven of interest to you in terms of asset classes and how they might perform. If you're investing monthly in the share market, keep doing so. If you've got a lump sum, avoid putting a major lump sum in at this juncture in the equity markets. A commodity fund, I believe, will serve you better as asset allocation, and stay away from the bond market. But having said that, it's not yet a short. There's going to be a fake out and it's going to get strength one more time. That's Francis. Think about your asset allocations, and that's my best guess for you.